Good morning, everyone, and happy Monday. Welcome to Dive diversity, including various ethnicity. I don't know why this topic is so hard for this title is so hard for me to read. It is starting to bother me. I'm gonna have to take speech therapy to just read our own title. It's nerve-wracking. But good morning and happy Monday to you all. I am your host, Iris Owens, and on the line with me are my two wonderful co-hosts. Good morning, ladies.
Good
Good
morning.
morning.
Please
Good
introduce
morning.
yourselves and say hello.
Well, good morning. Happy Monday. My name is Jessica Harrison. I am a realtor here in the Atlanta market with Berkshire Hathaway at the College Park and Cascade offices. I am excited to speak with Lanny today.
Yes, absolutely. We are excited. Good morning, Stephanie.
Good morning. I'm Stephanie Henry. I'm out of the Swanee office, which is Gwinnett County, Berkshire Hathaway agent. And I actually love talking finances. I'm becoming like, this is my favorite topic now.
Right.
Wealth, give me the money, show me.
So you're the money, so you're the numbers girl.
Hey, show me the money.
Show me the money.
Well, good morning, Lanny. We are so happy to have you back with us again. See, you're a rock star because now you've been on our show twice. So there you go.
I love it. I love it with his
No
beautiful.
one has been on twice yet.
No one has been on twice yet. So we
that's a high bar. I'm a little intimidated.
don't be. You're gonna take care of it and do well. So Lanny, introduce yourself, tell our guests what you do, who you do it for, and then we'll jump right in.
Sure, sure. My name's Lanny Arrington. I'm the regional manager with Prosperity Home Mortgage here in the Atlanta market. And we partner. We're the largest Prosperity. For those that may not know, obviously all of you ladies do, but those that may be listening to this that aren't familiar with Prosperity, Prosperity is the largest real estate owned mortgage company in the United States. And so originating last year around 17 billion in mortgages. And so I manage the loan officers here in our Atlanta market, and just commend all of y'all for for wanting to explore different opportunities and different topics. And as Stephanie said, just learning more about finances in general. I mean, it helps you educate yourself, and so we can help
Yes.
our buyers and consumers and individuals listing their homes. It just helps to educate them and make us better professionals too, because I always learn something from y'all as well. So it's always good for all of us.
Well,
Absolutely.
awesome. Thank you. Thank you. So Lanny, we're just gonna go ahead. You have the floor. Ladies, you know how we do this. Whatever your questions are, we just jump in. So Lanny, tell us, what are you going to share with us today?
Well, one of the things that we'll talk a little bit about, y'all, if y'all remember from last call, we talked about knowing your numbers. That's always something I always try to talk to people about. Another thing is, there's a few different ways that you could phrase it, because we've had a lot going on in the market, right? I mean, we're hearing something every day. It seems like with rates where they've gone,
Yes.
as far as inflation, how does that all impact? And I try to always look at these things and say, man, there's a lot of noise out there. How do we to get right to the point to make it where it's easily digestible for us all? Because let's face it, you can go down and watch some stuff. You can get on TV and start watching things that goes way over our head, and it's like, what do we really need to know?
Right.
And so kind of dive into that a little bit. And there's actually some really good things out there right now to be aware of, as far as positioning yourself as a buyer. So there's some good things there. You'll hear something that you'll hear loan officers talk about sometimes right now, as far as maybe date the rate, but marry the home, that kind of thing. That's a saying I hear a
Date
lot
the
of people
rate.
say.
Okay.
Yeah, and and we'll talk about that a little bit. So and so I kind of jump in first with just a general market update. So what we've seen kind of transpiring, it's kind of a culmination of a lot of different things, right? Over the last 2 years, it's been an unusual real estate market. And we still have a lack of inventory that you see throughout the country from homes listed. I may have this number, not exact, but pretty close. Throughout the United States right now, I think there's a little over 800,000 properties listed. And in a healthy market, you would probably see that number around 3 million. So we really have a
Wow.
shortage of property and inventory still right now. What we have seen is there has been what you'll hear referred to as quantitative easing. There really what's gone on over the last couple of years is you had a scenario where when a loan closes, and I'm trying to break it down to where it's just as common sense as it would be. When a loan closes, that loan, they get kind of bundled and sold off. You'll hear them referred to as a mortgage-backed security. They get sold off as a mortgage-backed security. Well, if you the federal government was buying a lot of those or really majority of those mortgage-backed securities when they were closed. And so they were kind of in a way, and they really were aggressive in doing that because you had COVID. They were trying to help prop up the economy, so we didn't see things kind of go sideways when you had all the issues that were started when we went down the path of COVID. So that was what they chose to do, and so now they're pulling back from that and letting it kind of return back to a normal market, or trying to get it back to a little bit more of a normal market. But what that has in turn done is it caused, there's a big void there, right? If you think about from a real estate, if you had the government buying all, 75% of the real estate properties in the United States, and all of a sudden they say, man, I'm not buying anymore, and then now you all of a sudden you have that big void as far as buyer, then it would cause the prices to come down. And that's what it's done in mortgage-backed securities. So there's less demand, there's been, less profitability for companies, and less interest, really, because the private sector looks at it and goes, man, here's a long-term investment. If I want to go buy that and I was only going to make 3% on my return, and I'm putting, tying up $700,000 for 30 years at 3%, does that seem like a really good investment? So,
Right.
You've had the market move now, it really driven as well to try to curb inflation. We'll probably see in November that the Fed chooses to bump the rate again. And so that is something that's probably going to come. And so just know that. But that's what the goal of them kind of getting inflation under control, because we've all felt that when you go out, whether it's gas or groceries or whatever it is, or even just going to dinner. Have y'all noticed you can't go to dinner now? And I mean, you go to dinner, you and another person, it's hard to go do that without spending $100, right? And remember, used to, if you went and you spent, you went out and spent $130 for dinner, that was a night out at Chops or Bones or something, you'd gone to a nice
Absolutely.
dinner. Now it's not like that. It's cost $100, if you go to Taco Mac, I mean, it's just whatever.
Right.
So it's things have changed, from that perspective. So we have seen rates increase. That has since had people pull back. We're not having near as many buyers. What I think we'll see long term is a leveling out of the market, where you will see, everything was over the last 2 years has been all on the listing side. Sellers could dictate everything. And the poor buyers, they just had to go along with whatever was being asked to even have an opportunity to buy the property.
Right.
Well, now you'll start seeing properties on the market a little longer, and then you'll have it'll put a little bit more. It'll equal out the market for the seller and the buyer a little bit more. The buyer will have more say so, and so that's, I think, probably a favorable thing for people as they're coming into the market. Are y'all seeing that already as far as properties on the market a little longer?
Yes.
Yes, definitely.
We're seeing properties on the market a little longer. We're seeing price adjustments on properties. We have not seen that in the past 2 years.
Mhm.
So, Lanny, let me ask you a question. So would you now officially say that it has turned and it is officially a buyer's market again?
I think it's definitely getting closer to that. I wouldn't still call it that, because there is still that lack of inventory. It's and I get this question a lot. A lot of people ask me, is this similar to 2007, 2008, 2009, that kind of when we went through that bubble? Totally different set of circumstances. Back then, you could ride through a new construction subdivision and there were 20 spec homes sitting on the ground, right? There was an overwhelming amount of properties that were out there. And if you had someone who unfortunately lost their job, they needed to unload their mortgage, they needed to sell the property to get out from under it. There was a surplus of inventory they were having to compete with.
Mhm.
You had these new home developments. You have so many REO properties, bank-owned
Mhm.
foreclosures that they're taking back, and they're all selling them so cheap. The guy who was trying to sell his because maybe he lost his job, now he had to sell it for so much less than what he paid for it. He was underwater. All these different, things that really were so difficult at that point in time. Right now, if you had somebody that was having difficulties, they could sell their house and sell it maybe not in 24 hours like they were 6 months ago, but they probably could sell it in a couple of weeks, right? So
Right.
it's still good from that sense. So we're not seeing a lot of foreclosures, but so there still is definitely an inventory issue there. So that is good for sellers. But from a buyer perspective, the challenge for the buyers that one, their offers will get looked at. There will be less competition.
Right.
The challenge for the buyer has just been the higher rate. And what I try to tell people, or because we will have customers or clients that we're talking to that they'll say, "Look, I'm going to just maybe we have already sent them through our Buyer's Advantage program." For those that may not know, Buyer's Advantage is where they go ahead and we get them fully underwritten as with a to be determined property address. So they're getting fully underwritten. This is not a pre-qualification. It's not a pre-approval. It is a full underwrite loan commitment issued. Really, they just go find the property, write a contract. We then order title, do an appraisal, and they're done. Really, so
Mhm.
great product. It gives them, especially when they were competing with so many people, it put them really in a good spot to have their offer looked at because they could close really quickly. What we're having some of those buyer advantage customers tell us now is they're going, "Man, I think I'm just going to wait. I'm going to wait until these rates get better." In my advice to them as we talk about it, I always say, okay, let's talk about that a little bit. Right now, you have less competition. Yes, you may go out and you may have to pay a little bit more in rate. You may not qualify for quite as much as you would have before, but you can go out and you have a much higher probability of getting a property under contract. And these are people who have maybe been out there spinning their wheels
Right.
for a good while trying to get a property and they couldn't get one under contract. Well, now you might can do that. Well, why don't you go ahead and do that, get in the home, and then when you do see that rate get better, then refinance it at that point. Because if all these buyers, if they all sat on the fence and said, "I'm going to wait till rates get better," so okay, let's say rates all of a sudden get better, what do you think is going to happen? Everybody else who's been waiting
Right.
for rates to get better, they're all going to go too. So now you're back having to compete with all these people, and then you very well may not get your offer accepted. So it didn't matter that the rate got better; you still couldn't get the property. So why don't you get the property now when the rates do get better? Refinance your current mortgage that you already have versus going out trying to start and find a property from scratch. So, and people, I think they understand that, and we're seeing that from a perspective of buyers when they really start kind of. It takes them a minute to kind of embrace that because they hear their neighbor down the street they got 3.5%. Now they're looking at 6.5%. And that's a little, understandably, that's a little hard to digest. But once you get your arms around it and realize we're probably where we're going to be for just a bit, then that demand or that need for that house is still there. Then it probably makes sense for them to move forward.
Mhm.
So wait, I have a question, Laney.
Sure.
I'm probably the oldest one of us on the call right now, but the interest rates.
I don't know. I probably have you.
I think I'm the oldest one on the call.
I don't know. Let's not reveal our numbers. But so the thing about the interest rates, what I'm trying to tell my clients is the 2.5 wasn't a normal market. I remember buying my first house, and we've all had pretty decent credit, been able to do VA, and we were still at a 6% interest rate.
Yeah.
So as we even, talking to them, I'm like, am I correct in saying you're not going to, that 2.5, that 3% was not a normal market, and you may never see that. So you sitting on the sideline now, this is normal interest rates.
That's right.
I mean,
That's
my
right.
parents had a 20% interest rate way back when.
Yeah, you hear people all of our parents when they were going through the 70s and they would you hear those stories of I had 15% on my mortgage when I bought, all of those things. I mean, so rates have obviously over time at some different points been much, much higher. So that's very fair. Where we're at right now, if you didn't have COVID, we were trending that way anyway. If you go back and you look at pre-COVID, we were already in the fives on interest rates. So it's kind of moving that way. Then a lot of things were put in place during COVID because, I mean, how long or how often in our lifetime, we had never gone through a pandemic, I mean, we'd not
Right.
experienced something like that. And so, you can always second guess and look back and go, why did the government do X, Y, or Z? But, you don't have a playbook for that. That's an unusual once in 100 years kind of thing. And you just figure it out. And it causes a lot of different challenges. And so, we're kind of dealing with those things now, and we'll continue to deal with them until we kind of move through this. But it's a mindset of, especially when you take younger people, first time home buyers, and they have not been around to see those other times. And we were the same way. When we bought our first house, I think our rate was around 7%. And so that was just very normal then, so we have moved to a very normal market or more normal market. I would say what you'll see, and this is kind of the old playbook that happens, is because from a financing perspective, from real estate, people are there's always going to be a need for housing. If you look at the population, it continues to increase. People need houses. So there becomes creative things around financing. You do not see the same lending guidelines were much more loose in those mid 2000s versus where they are at now. Right now is one of the lowest points ever for foreclosures. So you just don't see foreclosures are pretty non-existent. Again, it goes back, people can sell their house easily if they get in trouble. So so there's just so many different different things that have changed. But it's those people just get more comfortable. I think as they get more comfortable with the market we're in and rates, then you'll see them. It may be on the sidelines for a second. They'll decide to move in.
So Lanny, I know I was listening to a report last week that they were saying that buyers, there was like thousands of buyers who are like literally terminating their contracts. Like they're under contract, but they're so, like, with the interest rates continuing to increase, they're very bothered. And like I have a buyer right now who is building a custom built home. And so of course, when when he chose the lot, when we did all these things, we're technically still not under contract. Like he hasn't bought his land yet, and we still don't have a contract for the building of the home, because there was some things that had to be done because this is completely a new subdivision being built. So they had to build a road. So there are all these things going on. And so over the weekend, he called and he says, I'm getting really antsy. Like, I'm thinking I should pull out. I should, and I'm thinking, well, no, we don't want to do that, because you're not going to get your money back. I mean, at this point, and I understand where he's coming from. However, how do we help the buyer, understand, as Stephanie just said, so that 2.5 was not, that was not a normal market for us. That was all put in place because of COVID, right? To make sure that we didn't have a whole bunch of people going into foreclosure and losing their homes and that sort of thing. So that helped to stabilize the economy during the time that we weren't even making money. That makes sense, right? So how do we address our clients who are very well maybe under contract, especially on new construction, and help them to understand that what you thought your rate was going to be locked in at very well may not be that at this point? Well, it's not, because you've already missed that window of opportunity.
Sure.
But how do we keep them focused on and not jumping ship and canceling and terminating their contracts?
Well, so that's a wonderful question, and there's a lot to kind of unpack around that. But first I'd say, if you look at a lot of these new construction contracts, a lot of times there's pretty significant earnest money that's being put into it. Sometimes they put money in for just different upgrades and things the builder requires up front.
Correct.
That's non-refundable money when you get past a certain point. So if you took that number, and whatever that number is, and you divide it out over several years, the difference in the rate increase to their mortgage, let's say that the rate going from, if they were at a 5% rate, now we're going to be at 7. I'm just using general numbers. Let's say that makes a couple $100 difference in their payment per month. Well, if they've got $40,000 tied up in earnest money and upgrades that they stand to lose, at $200 divided by 40, that gets you a pretty long time down the road, that you could have went ahead and bought that house, not lost that money. You use that as your buffer, and then by then, I guarantee you there'll be a point when you see rates drop and you could have refinanced and got that better rate. So, I think there's different things there. I think that one, I would say something we do, and a lot of lenders do, is we have a 365-day lock. So we've got a loan that you can lock in for a full year. So, and that can be on new construction where you lock that interest rate. So the person, and it does give you a float down option. So when you get 30 days out from that home being finished, you can float down to the lower rate if the rates have improved, but you're guarding yourself against seeing a big increase. So if you see, if it's a rate that you feel comfortable with right now, maybe it's not the lowest rate you'd love to have had, but it's the one you're comfortable with, you could lock it in for that period. So that way, hey, it's not going to get worse than this. Then there's a chance when you get 30 days out that it actually gets better. So, that's something, and again, you're locking it in for a year. For a while, we were seeing some builders were quoting 14 months on new construction build because they had, supply issues as far as getting windows and just concrete, lumber, all the different things. Now that's really kind of getting a little bit better. And so, chances are, unless they're building a $2 or $3 million property, they're probably get that house done in 12 months or less. And even if it got 12 months and they need to extend a little bit, you could work through that. But so that's something I always encourage people to look at. Also, there are loan options, the creative piece that you see in lending and that you see that's kind of the old tried and true playbook. When rates start going up, people look at ARMs. ARMs are adjustable rate mortgages. A lot of people may be familiar with them. Some will not be. In the last several years, ARMs haven't been a logical loan option because if the rate was already at 3% on a 30-year fixed,
Right.
chances are the ARM was no better. Even at times we'd seen it where it was priced a little worse. So it just didn't make sense. Well, now you're seeing that ARMs will be, and they will continue to be, they'll be more of a viable option. Now, an ARM, if you did we'll use, for example, a 5-year ARM. If you do a 5-year ARM, that means your rate is fixed for 5 years. So it cannot adjust until after 5 years. Then it can go to it can adjust after that once every year after that. Doesn't mean that it will adjust. It could adjust downward. It could adjust upward. So that rate just can fluctuate. But what you find is, there's 5-year ARMs, there's 7-year ARMs, there's 10-year ARMs. And most people, this number varies. There's times where you'll see it where on average people in the United States stay in their house for 6 years, 7 years, 8 years. I don't know that I've seen it where it's been over 8 years, but people generally, they move in the house and they're not there for 30 years. They may tell you they're going to be there for 30 years, but life happens, things happen, jobs relocate, school systems change, they decide to move. There's a number of different things, but they generally do not stay in that property, for 30 years. And so the ARM, typically, depending on the length of time they choose that ARM, they could find one that gives them a long enough fixed period to keep them in the house as long as they feel comfortable. And then, then by the time it's ready to adjust, would be the time, hopefully, that they're looking to move on. And so that's something you see people consider more. Things you'll hear about more now are 2-1 buy downs. That's where the rate is lower for the first 2 years than it would be. So on a 2-1 buy down, let's say the matured rate would be 6%. So it starts off at 2%. That's the 2-1 buy down. Starts off if it's going to be a matured 6% rate. That means it started in first year it'd be 4%. The second year it'd be at 5%, and the third year in the remaining life of that loan it'd be 6%. So you get a little bit cheaper rate for the first 2 years, and then it goes to the matured rate. So you'll see that advertised, and that be something that's more relevant as we move forward, where it wasn't before. So those are just some of the creative things that you'll see product wise that kind of come along, and it may can help those new home customers maybe to look at those products as they get closer to closing versus when they started out looking at a 30-year.
Lanny, I have a question with regards to ARMs, and so I want to make sure, are ARM loans the loans that also, I remember back in the day when you had those balloon rates loans at the end, so you were paying, like, let's just say you had I think it was no money down, no interest or whatever, and then within a certain amount of time, then your entire loan was due.
Yeah, so there was a few different things you would see then. Back in those days, you had interest only loans, which you really do not see interest. The jumbo market still has a few interest only products that are out there, but for the most part, especially in the conventional space, you don't see interest only programs any longer.
Okay.
And a balloon note, you more often than not, now there were some of those back in the mid 2000s, but really a balloon note now is generally just more short-term money. And that's not generally it'd be a loan you went to a bank and you took out a 1-year loan or something, and it's a smaller loan. So you won't see that on just traditional financing now. With an ARM, there are caps, and that would be an important thing to talk to the lender about, is what are the terms on that loan. So generally there is so you wouldn't need to worry during the fixed rate portion of the ARM. So when it's fixed, if it's a 5-year ARM, it's fixed for 5 years, nothing is going to change during that 5 years. Just like having a 30-year mortgage, and these generally are 30-year mortgages. It's just that first 5 years it's fixed, no change. After 5 years is up, it could change once every year. And then there's generally caps to how much it can change during that year. So depending on what your caps are, it can't go up more than whatever that cap is from 1 year to the next. So there's some safeguards in there to protect you. You just want to make sure to talk to the loan officer and see and find out what those are. So, it just depends where the market would be. But generally speaking, I try to think about an ARM of trying to have that fixed period cover me through the period I think I'm going to be in that house, and then you go from there.
Okay. So Lanny, are these options, the ARM mortgages, the 2-1 buy down, are these options available to FHA, or are they pretty much just for like conventional?
You do have, I would say they're primarily more conventional products. You'll see out there, you might see some buy downs that are offered. You might see some, I don't know that I've seen FHA had some ARMs years ago. I don't know that I've seen any kind of FHA, but you might very well see something come along that is out there. But generally speaking, it's going to be conventional mortgages that you'll see these tied to.
Good to know.
So my question is, our first conversation was know your numbers. So credit number, are we still around the same, minimum credit score to get a loan, or has that adjusted as well?
Yeah, that's still the same. So for most, I shouldn't say most, there's a good percentage of lenders that will go down to a 580 credit score. You'll have some that go to 620, and you'll see some that go to 640. So for example, we'll go down to a 580 score, but if you're in that 580 to 620 credit score bucket, there's going to be you're going to be going on an FHA loan, and there's going to be some more requirements of you as far as they're going to see a little bit more reserves in the bank. They're going to want to see that you've rented a property for 12 months and that you've successfully been paying that rent. There's just a little bit higher of a hurdle because obviously your credit's banged up a little bit more. They want to make sure we're not putting this person in a position that doesn't create a successful outcome. They're wanting to make sure that we're not putting them in a bad spot, and so they're going to require you to do a few other things. But you can still, from a credit standpoint, we haven't seen credit scores change as a result of what's going on in the market. It's just really impacting more, what that mortgage and that is going to be, and that then lessens, generally speaking, what the amount they may qualify for. To know your numbers, that is where, I want people to know before they meet with a mortgage person, before they meet with a real estate person, that sit down and kind of just know what you feel comfortable with. What do we, just because you might be able to afford a $3,000 a month mortgage, does that really put you in a good spot? You know your finances, some people, they go home, they sit at home, they don't do anything else, right? You got some other people, they like going out every weekend, they like eating out all the time, they love to
travel.
travel. You got to know, what do you want to spend money on? What's your quality of life look like to you? That's different for everybody. And then you find okay, so if I'm going to do all these other things, how much does that leave over for my mortgage? And then you got to make that fit in that box, right? So you kind of need to know what you feel comfortable with, that I can tell them, hey, here's what you qualify for. But that qualification, is that going to then cut into all the other things they like to do? And then they're house poor and they just have to sit at home all the time. And if they don't like sitting at home, then they're going to be miserable, right? So you got to find that comfort zone of what works for you, right?
Party at my house every weekend.
Exactly. You got to find something.
I can't leave home, so you all have to come to me.
And bring a dish.
And bring a dish. It'll be a potluck, by the way.
Exactly,
And BYOB,
exactly.
bring your own bottle too while you're at it.
So true, so true.
So how does I know, ladies, we talked about the PMI before. How does that affect with these type of programs? Is it still going to be the same if you're not putting at least 20% down? Is the PMI even an option with the ARM? Can you explain that for me?
Yeah, so PMI generally is you'll have mortgage insurance. And for those that may not know, especially if we ended up with some first-time home buyers or listening to this, mortgage insurance, the less money, this kind of historically, I'll tell you a little bit where mortgage insurance came from. Historically, and I'm painting with real broad brushes here, but historically, the higher the loan to value, so the less money that someone has put down, the less skin they have in the game, so to speak, you would see a correlation to higher default ratios, meaning there's a higher rate of foreclosures. So if you think about it, if somebody got 100% financing for their home versus if they made a 50% down payment, well, when people come into hard times, if they bought the house and they got 100% of it financed, they didn't really have any money invested in it.
Yeah.
It's easier for them to walk away from it, right? If they put 50% down payment into it, they're less likely to do that because they've got a lot of money tied up in it. So, over time, you saw lenders would see, hey, the more we lend, the more we end up having foreclosures, or the higher rate of foreclosures. So the mortgage insurance is insurance for that lender or loan investor to protect them against the foreclosures. So the 80% financing is a rule of thumb. Generally, if you're above 80% financing, then you will have mortgage insurance. It does get tiered and it becomes cheaper as the more money you put down. So if you put 10% down, so to speak, versus financing 97%, your mortgage insurance is going to be cheaper than it would be with the higher financed amount. FHA has a standardized amount that they would have on every one of their loans. So those things have not changed. And it would be the same way with an ARM. You still would have mortgage insurance unless you put 20% down. So, same kind of scenario. But one thing that I would tell you, that these are some creative things we can move into as rates have gotten higher. And this is really something that I want to talk about from a seller's perspective. If you think about a seller, we're coming from a market where sellers, we're not having to do anything, right? I mean, people are coming up with different things like, man, you don't even have to move your stuff out of the house. I'll get a U-Haul, I'll get a dumpster out back. We'll clean it out for you. So the sellers, they had it great. They could do whatever. Well, all of a sudden now, if we start seeing where the property's sitting long, and the seller's got to figure out a way, how do I get more people to come look at my house, or how do I get them to want to put my house under contract versus the next guy's? You got to start looking at some things. So one thing that we have seen, and this has really been more right now, and this will change probably by the next week or two, it may sort itself out. We saw a lot of volatility in the market last week. And so as we were pricing rates for customers on FHA loans, there wasn't a par rate. A par rate is a base rate, interest rate that doesn't cost the buyer any discount points. It doesn't cost them anything.
There wasn't any?
I'm sorry?
Did you say there wasn't a par rate or there
There
was?
wasn't, yeah, that was what was so unusual. There wasn't a par rate. So if you went to quote a rate for a FHA customer, they were having to pay discount points to get the highest, even the highest rate you could quote them, it was still costing them discount points. And a lot of that is just the uncertainty in the market, and it had not if you kind of Google and go see what's going on in the bond market's been all over the place, and that affects rates. And so it was just a real odd set of circumstances. This may sort itself out over the next week or two, but as a seller, if you're writing a contract and you're offering some closing cost that, and you can write it in the contract that this could be used towards closing cost or as a discount, buying a rate down, something along those lines, the seller can then enable them. That's something to think, how attractive is it for me too, if I'm going to be in this property for a while, if the seller, if I'm able to use some of the seller concessions to go buy my interest rate down, then discount points can be a good thing. In discount points, for those that may not know, it's you're buying, and so an interest rate on that given day, if it's let's say it was 6.5%, well, you may be able to go down, and this number changes every day, and it's not a direct correlation. You pay one discount point, that doesn't buy the rate down 1%. The amount or the cost to buy that rate down, it's driven by the interest rate market, which is tied to the bond market. So that number can change every day. So you'd have to check with your mortgage professional, and they can quote you and tell you, here's how much it costs on this given day to buy it down. But you may be able to buy the rate down from 6.5% down to 6%. Well, over time, that may be a much better investment in using those seller concessions than it was to pay closing costs. Maybe come out better paying your closing costs out of pocket and use that other money to buy your interest rate down. So that's something that the sellers can offer as well. If they're offering some concessions there, the seller, lender paid mortgage insurance, that is an option. Lender paid mortgage insurance is where basically upfront that premium has been paid by the lender. Now there's a cost to the buyer to do it, which the seller could pay, but sometimes that cost is something that would make sense. You just have to look at it again. It changes and varies, but if the cost was not too expensive, then doing that gets rid of your mortgage insurance, even if you're financing 95%, and so that can be really attractive as well.
Lanny, I have a question, because this is something in being in this business, and I think even sometimes buyers don't understand. And it sounds, when it's said, it sounds very biased, I think is a good word.
Okay.
So the buyer who has an FHA loan versus the buyer who has a conventional loan, or the buyer who has a VA loan, or at one point even a USDA loan. Can you explain why sellers will ask the question, or sellers will choose sometimes the buyer who has the conventional loan versus the buyer who has the FHA loan? Or
you hit a hot button for me, Iris. This is a hot button.
Ooh.
I could say, well, the one word I could say is not, I don't want to say because it'll sound ugly. I would say, this is more polite. We're going to call it misinformation. So
okay, thank you.
they have received some misinformation.
Yes. Let's educate. Let's educate.
Yeah, let's do. So from a lending perspective, well, I think a lot of that is rooted in years gone by. Maybe in years gone by, there were a lot more difficulty around an FHA loan, different things like that. And a lot of times we hear people come up and they say, what's the appraisal? We're worried more about the appraisal under these things. Let me just tell you, if it comes up, as a general rule, we don't see, I so rarely see, again, we did 17 billion in production last year. We had, here in the Atlanta market, it was around 3,500 loans we closed. So we touch and see a lot of loans. Rarely do we see an issue on an FHA appraisal that wouldn't have been an issue on a conventional loan. If an appraiser is walking around, this is kind of the rule of thumb. If you're walking around a house as a buyer, as an agent, or whoever, and you see something that you look at and would be concerning to you, it's probably going to be concerning to the appraiser, regardless if it's a conventional or an FHA loan. There's a few exceptions, but it's for the most part, those are things that have to be addressed either way. And what you're usually looking at is structural issues. You're looking at safety and health type of issues.
Right.
And so those are things that that you really they can come up and be problems any which way you go. But so those are, I think, a lot of times the hesitancy around when an agent was getting an offer on a FHA or VA loan and a conventional, they always wanted to choose the conventional. Even sometimes if the conventional was less, they wanted to go that route. It's not always a great decision. And the reason being is, so from a lending perspective, there's certain things I can't disclose, as a lender, you can't disclose to the agents. And you may have two borrowers. Let's say I was, just by chance, I was working with two different borrowers, but they were interested in the same property. And one of the borrowers wanted to go with a conventional loan. One of them was a FHA loan. Well, this guy going conventional, he may be very marginal. I mean, he's right up against the debt to income ratio guidelines. His income is a little bit, suspect. It's not, we've still got a little uncertainty. We've got to work through around his income. There could be some things in his situation that could go sideways. And when I mean that is, like, if he's right up against the debt to income, and let's say he doesn't have a lot of money, he's barely scraping by. When he gets, after he buys his house, he's only going to have a few dollars left. He does not have any bandwidth or any margin for error for anything to pop up that's unexpected. So, and by that, I mean, he goes out and he gets his, and again, we're talking about somebody who's barely got a credit score that qualifies him. He goes out to get his homeowner's insurance. Well, y'all all probably know, when you go out to get your homeowner's insurance, now credit score really factors into what that homeowner's insurance premium is. And so let's say now his insurance is quoted really high because his credit's a little banged up. He's barely qualifying with the credit score he has on conventional. And so that guy's now, and then he also, maybe he's buying in a place where property taxes come a little higher than what he anticipated. So now is in those two things, he was already up against it, and now those two things have moved past where he no longer qualifies. So those are that. And this guy over on the FHA world, maybe this person is a young person or a young couple. They're fresh out of college. They've got excellent credit. They just they haven't worked long enough to save a lot of money, so they want to finance a little bit more. And that's the reason for wanting to go with an FHA loan. But they may be, professionals, have great jobs, great credit. I mean, they're just pristine, wonderful buyers. And then you've got this other person that's marginal. Well, something too on a conventional loan, it's more restrictive around debt to income ratios. It's more lenient on FHA. Every lender, you could go talk to every lender in the country, and they would tell you they can take two loans, and it could be the same borrower. They may run it through one of the automated underwriting systems that you've got to run it through on a conventional loan. They don't get an approval. They turn around and run that same buyer, same scenario under an FHA loan, and they do get the approval. That happens every day, all day, that y'all wouldn't see, that only we would see in our side of the world. And so, the chances of you give yourself more grace or more leniency with an FHA buyer than you do with a conventional buyer. Now, all FHA buyers aren't the same, right? There's some FHA buyers who are credit challenged, and they're up against it too. They're barely qualifying, and a little something one or the other could throw them out of whack. But they're just those two things are, you just really have to look at an individual, and that's where developing that relationship with the lender, so that again, they can't tell you all the things about that, but they can certainly kind of say, Iris, this is a very strong buyer. They could kind of give you some communication that might be helpful to you. Just it's very general. VA, again, VA, our veterans, they've done so much for us. They're out there, putting it online every day. And I just feel like it hurts my heart when I see people not want to accept VA offers. And again, so often that VA buyer is a slam dunk buyer. They're a great buyer. Now, VA still has to go through, that's where For those that don't know, VA uses their own set of appraisers.
Yes.
So any other time we have our appraisers go out, we have a lot more control of that process. And I
Mhm.
think that's what makes people nervous is when it goes VA, you have less, control there. But as a general rule of thumb, we have right now what we would call, we call it in our world a sales variance. That means where the appraisal comes in at a different value versus
Mhm.
contracted price. Meaning appraisal could come in low versus what the contract price is. It's so seldom we see that. I mean, it's so seldom. It's one of the smallest sales variances we've had in a long time. So we just don't run into a lot of value issues on appraisals right now. And so again, if I'm just speaking from myself, if I were selling my house right now, I would not have a hesitancy in accepting a VA offer. And we do this all day, every day. So it would not. Again, VA is much more lenient than conventional in a lot of areas. They can do 100% financing. They don't have mortgage insurance. A lot of times the veterans choosing that program, not because they couldn't qualify for a conventional loan, they're choosing that program because it's better for them. It just gives them a better rate, it gives them better terms. Why would they not choose it?
Absolutely.
And so that's unfortunate. You go, man, here's this veteran, he's got this benefit for a loan that's better for him and his family, but we don't want to take the offer and we want to put him in a worse loan because we think it's better and it's really not, So, and again, there's times that you can run into some issues, but it's just not very frequent. So I think as we move away from these things and we kind of get into a little more equal footing for buyers, that then they do entertain these. But I think it's our responsibility to get the word out, that people understand, these are not bad programs. This really all comes back to the individual. What is their sort of circumstances and why are they choosing that program? Because there may be some very legitimate reasons, and they may really be a better buyer than that conventional person that you were looking so strongly at.
Right.
So
Great question, though. I'm sorry I rambled, but that's my
thank you. Because I want to hear it. I want people to hear it from a lender's perspective, not from a realtor's perspective or what they're hearing, like you said, like street talk. You want people to understand really the difference and what they are up against depending on your loan. But you're going to qualify for what you qualify for, and that shouldn't knock you out of being able to buy a home. The bottom line is I qualified for something, so I should be able to buy a house. So.
Yeah, absolutely.
So I have a statement and a question.
Sure.
My statement is a little biased. If you want to thank a vet, accept their loan.
Absolutely. That's so great. And we've actually talked about, we ought to put a marketing program around that, because we do have Veterans Days coming up in November. And yeah, what a great way to thank that vet. Thank you, Stephanie. That's a wonderful way.
That's wonderful. That should be a campaign, Lanny, just so you know.
Absolutely. We've talked to Deanne a little bit about that. That was one of her brainchilds. So it's great. I love that.
We always like to be in the forefront. So hey, let's do it.
Get on that.
This is not a plug. This isn't a plug for Prosperity. This is truly just what it is. So Wes Foster, he is the CEO for Long and Foster. And for those that may not know, it's a large mid-Atlantic real estate company. I think they have about 10,000 agents. But he's the person that started Prosperity, and he was a veteran. And so from day one, they've done a phenomenal job on their veterans program. On our VA loans, we don't charge any lender fees. We don't, zero lender fees, and we refund that veteran their appraisal fee at closing. So that is our way of saying thank you to them. And so that's, from a business sense, a lot of times, a lot of companies look at it and go, that doesn't you're cutting into your profitability. That's not what we're doing those loans for. We're truly trying to help those people and tell them thank you for what we're doing. So that's, we kind of put our money where our mouth is on that problem.
You guys still pay their appraisal fees? You return their appraisal fees?
We return their appraisal. Yeah, they have to pay for it up front, but then at closing, it gets refunded to them. They'll see it on their settlement statement. They'll see a credit for that appraisal fee.
Right. Okay. All
Absolutely.
right. So I was going to say, anybody have any other questions?
No, this has been very informative. I think the biggest takeaway from today, for those listening who may have been on the fence of moving forward, is that rates are not dropping anytime soon. And like he said, let's date the rate and marry the home.
Yes.
Meaning, let's get into that home and we can always refinance later. But of course, know your numbers. It's a lot of key points that you gave us today, Lenny. And I really appreciate you breaking down the differences between the FHA and the conventional and VA loans, so that those individuals now can understand a qualified buyer is a qualified buyer.
That's right.
Correct.
Regardless of what their finance, scenario may be, a qualified buyer is a qualified buyer. So that is the takeaway that I have for today. And I'm very appreciative for this information. Hopefully those listening will also have those same takeaways.
Absolutely.
Ladies, what you think?
Stephanie?
Well, so one of the things that just came to my mind is, it's kind of a question, but when a seller sells a home,
Mhm.
at the closing table, you get 100% of your money. So why worry about what loan program they have?
Because their concern is that
They
if
can get to that table.
if we go to are they going to get to the table? Is that correct?
They're gonna get to the
It's
table.
more
That's right.
about
That's what we're about.
it's more about. So I'm going to take versus taking the FHA versus the conventional, because I believe in my head that this conventional person is a stronger buyer, as Lanny just described, that is not always
That's
the
not
case,
true.
right? The FHA buyer may be the strong, or the VA buyers may be the stronger buyer, because they have to do a whole lot more work to get qualified. So that means they are putting their ducks in a row, whereas a conventional person may have the income but does not have the reserve, or vice
They
versa, or
may
doesn't
the
have the great credit,
score.
right?
They
Or
may have
doesn't really have the money. So
Well, you can run into the same scenarios
Right.
with all loan
all
programs.
loans, right?
Exactly.
So,
But
Absolutely.
sellers are concerned that we're not going to get to the closing table because I don't think that you're a strong enough buyer.
Mhm.
So that's why I was very concerned, and I wanted Lanny to explain the difference, because this is sellers are, and I said the first thing when I came into the business, I was like, what difference does it make to the seller what loan they have? Like, but I understand their concern is, are we going to get to the closing table? And as Lanny said, the program they offer us is that you're fully qualified when you are looking at your home. They're just waiting on you to find the home, to put the address in. So that's even better than a pre-qualified or a pre-qualification. I mean, a pre-approval letter. They're telling you this person is ready to go. So that makes you an absolute strong buyer, viable buyer.
And usually what's happened is somewhere along the line, somebody got burnt in years gone by, and it could have been something 20 years ago, and you could have had an agent that had a VA or FHA loan go south, and they've had a bad taste in their mouth from that experience. But that's not how it always is, and that's really not how it is in this day and time. And so I just say, to really give them all consideration. What I'm going to leave y'all one thing today that is just, I would say, and if we were fortunate enough to have potential buyers listening to this, I was talking to a friend of mine who's a builder recently, and we were just talking about industry stuff in general. And he was making the comment, he said, look, our industry and our business as a builder, it's not set up to see things go down. You may hit, if you look historically, you'll see it, and you look at a graph, you may see that prices of homes at different times dip a little bit, but it's trends slowly upward. So, I've been doing this over 20 plus years, and I can remember when, you did a $250,000 loan, and that was a nice, it's all brick, really nice house, 3,000 square foot. You're like, this is a great house. It's 250, and that was a big loan. Now, we see, it seems like you see $700,000 properties as a dime a dozen. We just saw conventional, conventional loan limits have gone, they're going up to $715,000 on a conventional loan, So it's not their industry. His point was, our industry is not built for things to get cheaper. They're going to get, more expensive. So Mr. Buyer, you need to jump in before, over time. You might catch, trying to play the dip and get it when it's lower is risky and can be
dangerous game.
Yeah. And so, over time, you may look back and see that you actually ended up on the wrong side of that. I was looking at, if you're looking to say, otherwise, as a buyer, if you don't have mom's and dad's basement to go live in, then you got to find a place. What are you going to do? You're going to go rent, right? If I was looking at numbers this past week where the national or the average for Atlanta, let's just look at Atlanta. I'm gonna give you two numbers. If you're looking at in Atlanta, a 1-bedroom apartment on average is $2,200 a month in rent. That's a pretty nice mortgage. You could go buy a proper private mortgage instead of paying somebody else's mortgage. If you're renting and you're paying that rent, you're paying somebody else's mortgage. If you could go and you're in a position, and look, everybody, there's times and places I've rented a place before, you know, and we all have probably done that at some point in life. There's a time and place in your life when you need to. But if you're in a place and you have the ability, it's a much more wise investment to go ahead and buy that property versus paying that mortgage. Because again, properties are going up in price, but they're also going up in rent. So $2,200 for a 2-bedroom, it was $2,400 in Atlanta. If you go to New York, and Iris, you'll appreciate this because I know you're a former New Yorker.
Yes.
And there's 4 people in New York. I'm like, man, I understand why they're all moving to Georgia now. You know? a one bedroom rent in New York was $5,500 on
That's
average.
right. That's right.
$5,500. A 2-bedroom was
Yes.
$8,500.
Yes.
$8,500. I mean, think of what kind of house you can buy in Georgia with an $8,500 mortgage. That's crazy. So, you know,
It's funny you would say that, Lanny, because when I first moved to Atlanta, my friend bought their first house, $250,000, 4-sided brick, you know, 4 bedrooms, fireplace, da 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 da. I remember walking into the master closet and I said, this is a studio apartment in New York. And you know, I'm not lying. And I was not. That's a studio. Master bedroom closets in Georgia were studio apartments in New York. And you were paying at that time, you could be paying $1,100.
Yeah. It's same. I had a friend that same thing. They moved to California, same experience. You know, it's just what they got for what they were paying and what they got. It was just a little box. I mean, it was nothing to it.
Absolutely.
And it was really crazy expensive. So, you know, that would be my thing is just look, you get with a great agent, you get with a great lender, let them give you some sound advice and they will help you find a property in a situation that's good for you and your family. And that's really, I think, what all of us are trying to do. And and that's just, you know, we want to see people successful. We want to put them in the best position to succeed. And so it will be an unusual market for the next little bit, or I should say it's more normal. It'll be unusual versus what we've seen the last couple of years. But there's still ways to make things work for people and to put them in really good situations.
Thank you, Lanny.
And so, guys, thank you all so much. And we just want to remind you, you all have gained some great knowledge here today. So listen, it's fall. Fall in love with your new home. Dive into your numbers so that you can fall in love with your new home. And then date the rate and marry the home. So you guys have a wonderful, wonderful rest of the week. We thank you all so much for joining us. Lanny, amazing as always. We appreciate you so much for always imparting knowledge that we all need on all sides. So we appreciate you. Ladies, enjoy the rest of the week. Thank you all so much.
Thank y'all.
Bye.
Bye.